Joe Quinlan, head of market strategy at Bank of America, joins us today. We'll be talking about his outlook for the economy, inflation, monetary policy, stocks, bonds, asset allocation in 2025. Will stocks rise or crash in Q1 into the end of the year? Will bonds face a similar fate as 2022, which is to say a big bear market for bonds? We'll find out with Joe. Welcome to the show, Joe. Good to see you.
Thanks for having me on, David. Appreciate it.
Let's start by talking about this market froth that some people were talking about. 6,000 S&P 500, Bitcoin over 100,000. Some people have been telling me that the market needs to wash away some of this froth in Q1. Do you agree?
Well, I wouldn't disagree, and I'd expect that to happen as we go into deeper into January and February. In fact, we gave up a little bit here at the end of December. So, a lot of exuberance. I wouldn't call it irrational given the earnings outlook, the outlook for the U.S. economy, but I've been pleasantly pleased that we've seen a little bit of a pullback here since busting out of the gate since post-election. So I think it's healthy. Hit the pause button here, reset as we head into the new year.
I believe that economists at the Bank of America, correct me if I'm wrong, have a 66,000 or 6,666 S&P 500 year-end target. Can you walk us through that logic and whether or not that's a straight line upwards or is just going to hover around that target? Is that an average? What's the rationale there?
Yeah, it comes from my colleague Savita, and she has to put out a year-end target 666 between now and the end of the year or end of 2025. How do we get there? Good earnings overall, better breadth, an economy that continues to expand, say 2.5%. We think a lot of these policies that we're talking about that have yet been put in place, whether it's lower corporate taxes, deregulation, fires up the animal spirits. So, it won't be as you know, David, but, we're looking for a pretty healthy market returns at the end of 2025, coming off, as you know, a very good 23 and 24 in terms of S&P 20% plus return.
Okay, so then you and your colleagues are not expecting a recession then?
No, we've kind of gotten off the recession kind of narrative here. You've got a good U.S. consumer out there. They're feeling the wealth effect from the stock market, the housing market. Remember, higher income households here in the United States, they disproportionately drive consumption. So lower income households for sure, feeling the pain of credit card costs going up, feeling the pain of squeeze from inflation. But that high-end consumer, with the employment backdrop being as it is, with the net wealth effect kicking in, we think the consumer hangs in there. And you overlay capital expenditures, more on AI. We'll see what happens with the Trump administration about reshoring, if that works, manufacturing. So there's no narrative in and around recession right now that we're basing anything off.
Well, what about, I'm just throwing this out there, what about the threat of tariffs? Could that go too far? Could that induce a recession?
I think, David, great question. It's a great known unknown because we spent a lot of time studying it, trying to figure out how it would be sequenced, on who, Mexico, Canada, of course, China, how much, what industries, what products. There's a lot of pushback from the private sector working with the President-elect Trump administration about what actually is going to happen on day one. So yes, tariffs, I think, more of a micro story as opposed to macro. In assuming these are targeted, not their blanket, and they're directed more at China than our trading partners, Mexico and Canada, that you could shave off 0.1, 0.2% off of GDP, but there's enough demand out there, enough capital expenditures out there to keep the economy moving forward by that 2.5% into 2025, over 2025.
Let's talk about the Trump trade for just a minute and tariffs in particular. Any particular sectors you think will be hurt more than others from tariffs? I know that Trump's administration may look into a broad-based tariff system on our trading partners, but some certain sectors may still be affected more than others.
Yeah, David, to kind of peel that onion, I mean, just suppose there's tariffs, between Mexico and Canada. Well, that's going to hurt on the automobile industry here in the United States because a lot of cars are produced in Mexico and Canada, and they move across the borders multiple times before they come across as a finished product. So that's number one. Retail, maybe like a Walmart or big retailers that depend on that, high volume, lower cost products out of China. If we slap tariffs on those goods, that could be a problem. Yeah. And then you got to look at it the other way around as well, David. It's not just what the U.S., the tariffs we impose on certain sectors, certain goods, but what will China and or our trading partners do in return? So we're already seeing China put in place export restrictions on rare earth minerals, some other strategic metals and minerals that could hurt our manufacturing, could hurt some of the production industrialized in the industrial space when it comes to aerospace, heavy equipment. So it's really it's multi-layered, but I think it starts with retail, kind of those consumer goods, automobiles. And then the last thing, remember, we're still looking for small caps to do well in 2025, but small businesses, they're huge importers, right? They bring in a lot of products from Mexico, from China. So they're not, if you're going to hide out in big cap companies with these tariffs, that's not necessarily the place to be, or small cap. Everyone's going to be affected.
What about the impact on inflation? We'll talk about monetary policy in just a minute, but people are talking about how tariffs may be inflationary. Do you agree?
Not necessarily. I think the more deflationary because it slows growth, creates product. I think there's substitutes, and I think we can find that, but I don't think they're hugely inflationary in an overall sense. They're a one-off. I'd also say, David, I don't think they were able to raise a lot of revenue either. So if this is about raising revenue, I don't think that's going to be a big contributor in terms of filling that fiscal gap as well. But this could be more deflationary than inflationary overall.
I see. So the last FOMC meeting must have surprised markets because we saw a big drop in the stock indices right after the 2 p.m. announcement. The expectation for more Fed cuts, that's, I guess, been reduced after the last meeting. Can you walk us through the rationale of what Powell was trying to signal in terms of not supporting the economy as much as perhaps he did before? Is it because he's afraid of higher inflation prints in the future, or something else?
Well, I think, Chair Powell's keeping a close eye on inflation, as you know. He's keeping very close eye on employment. But then there was also, David, in the minutes or kind of in the press conference, some of the Fed governors are looking through and trying to figure out what does inflation mean against a backdrop of more anti-immigration, higher tariffs, everything we were just talking about. So I don't think it's Chair Powell, but the Fed in general is trying to game out what happens to prices if the incoming administration does what they promised to do, raise tariffs, anti-immigration, which creates labor problems. So I think that was part and parcel of the message. Another part and parcel of the message, yeah, I think they were boxed into the corner. They had to do 25 basis points in December. But this economy has a mind of its own. It's growing by over 3% as we close out the year here in 2024. So I think there is an increasing debate amongst many economists, mainstream economists, respected economists, talking about why is the Fed cutting at all, given the fact that inflation, it's above target, but it's below 3%. Got a good economy. What's the point? And the last point I'll make is our economists were expecting two rate cuts next year. So in March and in June. So I think the markets were a little offsides, expecting the Fed to go beyond, say, 3-4 cuts into next year, into 2025. Because let's face it, the economy is slowing. We're going to see, I think, the unemployment rate back up a little bit here. But in general, when you got a good consumer, high income consumers out there spending, and you see it in services across the board, then it's hard to really pencil in this recession, and therefore the Fed to continue to cut as aggressively as the street thought they were going to.
Is there a possibility that we can see consumer spending wane in the wake of higher consumer or higher inflation expectations? For example, if households expect inflation to go up, perhaps they'll be spending less money. What do you think?
I think, yeah, David, I think that's right, but that's the lower income households. Okay. Already they're being pinched and squeezed. The unemployment rate's a little bit higher there. What slows down the higher income households is typically a shock. It's 9/11, it's the great financial crisis, it's the pandemic, anything that leads to that negative wealth effect. Negative wealth effect combined with higher unemployment pulls in the horns of that higher income household. So, it's going to happen at some point. But we don't see that happening just now. And remember, most of our energy economists on Wall Street are looking for oil prices to stay where they are or even come down. So that is going to help kind of keep inflation in check and keep that consumer out there spending, higher income and lower income.
It'll come down because the next administration wants to drill more?
Drill. That seems to be their mantra. But, we're underweight energy. We think it's attractive. But if you got more supply out there than you have demand, that's not a good backdrop for earnings when it comes to the energy sector.
All right, take a look at my screen now, Joe. Here is the S&P 500 overlay with the Russell 2000 on a year-to-date basis. The S&P is up about 28%. Russell's up 12.8, 13%. Over the last 5 years, similar story. It's just underperformance by the Russell. Is 2025 finally the year that small caps and mid caps start outperforming the large caps in the bull market?
I mean, David, honestly, I don't think so because I think these big companies have just so much free cash flow. They're spending. They have a technological lead out there from relative to the rest of the world. What could slow down the growth story on the kind of the mega tech, magnificent seven, which we're watching very carefully, is that deterioration between the United States and China leads to more restrictions on U.S. companies, tech companies, being able to sell into China. And people don't realize, we think of China as kind of a source of demand, supply, when it comes to, exports, sending us products and so on. They're also a source of demand. They're a huge source of tech demand. And so, the outperformance of the large cap could be impinged or hurt by a U.S. China deterioration in relations. That's for sure. Stronger dollar could do the same thing. And that's a too strong a dollar. So, but, I honestly think the earnings potential of the large cap just outweigh the small cap. And if we have a Fed now that's going to be cutting less than expected, that augurs, against the small cap story as opposed to the large cap. So I think that outperformance that you're showing us here continues. Maybe it narrows. I would expect it to narrow over 2025, but I wouldn't be surprised if it continued, for the next 12 months.
Well, you mentioned the large caps may be hurt by the trade wars with China more than the small caps. Can you explain why?
Yeah, because what happens is people don't realize that U.S. companies, whether it's food and products, automobiles, technology companies, they make a pretty good chunk of business in China, being invested in China. Mm-hmm. And now that's turning, and it has been turning. So some of these big cap names, whether it's I can't mention them, but it's sneakers, it's coffee, it's automobiles, it's technology. They're in the crosshairs of a potentially deterioration in U.S. China trade. And David, here's the thing. Since Trump started the tariff wars back in 2018, the street has assumed that there's been a lot of decoupling from the United States and China, when in fact, the United States and China are still very much joined at the hip when it comes to finance, commerce. We're needing their metals and minerals. We needing their markets, and vice versa. So there's still a lot of unwinding that could happen if we don't find an exit ramp to kind of tap down the tensions that are bilaterally that are building. So, my whole point is it could get worse before it gets better for U.S. companies when it comes to the impact of China and their overarching earnings.
Okay. Well, let's talk about tech stocks for just a minute. I know you can't name specific names, but we can talk about the sector overall. The NASDAQ composite, again, new all-time highs this year, continuously breaking records. How rate sensitive is this particular sector? And I bring this up because the 10-year yield, which we can talk about in just a minute, has been going up. So I wonder if that's going to affect the tech sector at all.
I think it'll raise the kind of the conversation with all the investment strategy committees. And if we get closer to 5%, how much do you want to own growth? What does that mean? And I think big thing, so the interest rate outlook is going to be very interesting for tech growth in general. But then also, David, I think, and I think this is premature, but the street is looking for this AI infrastructure build out, these big CapEx spenders, the hyperscalers spending billions of dollars building out the AI infrastructure. They're looking for, the gains to the real economy, the productivity to flow through, to see that return on investment is actually being pulled through. I think that's too early, right? It's too early to think that the AI infrastructure build out, these hyperscalers, all the money they're dumping it now into capital investment, is going to see a significant rate of return to their bottom line in 2025. I think this is a story for the second half of this decade, not for 2025. So I think, remember we saw in the summer, there was a little bit of hiccup with the hyperscalers because investors were getting overly concerned. They were spending too much on the infrastructure. They kept spending anyways. But I think in the next 12 months, there could be some hiccups here, pullbacks related to that spending. And we would see that as a buying opportunity overall.
Okay. What do you think are some of the bigger tech themes for 2025. 2023 and much of 2024 was dominated by AI. Quantum computing is just reaching headlines on the news. Is that the new theme, or is there something else here?
I mean, the biggest theme is going to be how much is all this CapEx spending in AI, the infrastructure,
Mm.
how much is that going to filter through into the real economy? And there's some studies out there where there's Bain, McKinsey showing that, in general, less than 10% of companies are actually seeing any real productivity benefit, right? I mean, part of that American exceptionalism, part of the reason investors want to own the US versus the rest of the world is that we're on this cusp of a productivity led boom thanks to the AI infrastructure build out.
Yeah.
Well, if that doesn't materialize, or if it's delayed, or if it's kicked into 2026, then the market's going to have a problem, a little tantrum that could create some pullback. So there's a lot riding on this AI productivity boom, and I think it's coming. But I don't think it's going to come in the next 2 quarters, but we'll see.
Here's the price of copper. When you say that capex may slow next year, are you expecting the base metals demand to also wane?
Yeah, the base metals, copper. I just think there's a lot of supply coming out. The
Mm.
mining companies kind of like lagged a little bit here. We're bullish on commodities in general. Whether it's silver, copper, we like for long term, energy less so. Uranium because of the nuclear renaissance that's out there playing out. So commodities, it's kind of like buying Europe. You got to be more specific. You got to buy
Yeah.
commodities, I think, individually as opposed to buying Europe or a basket. So it's going to be interesting. But supply and demand, as you know, always dictates that and where we are in the cycle.
So you're bullish certain metals like silver and there's copper. How do you feel about that? You're
Yeah,
just kind of
I think we like copper here on the expectation that Europe's economy is bottoming out.
mm,
China's stimulus finally kicks in. The U.S. manufacturing base continues to expand, and so you're going to need underlying copper. But it is really you got to own the right companies at the right time. Sometimes they're more of a trade than an investment, as you
right.
know, highly cyclical. But copper in 2025, we like, yes.
Okay, so 10-year yield. Let's take a look at this. 4.587 is the last print on my screen here. What do you expect the bond market to do? I mean, this is looking awfully like the start of 2022, or am I reading too much into this?
Yeah, I think that hopefully it's not.
Okay.
we
All
know we
right.
know how bad that was painful for stocks and bonds. I mean, our forecast team, interest rate team, is looking for the 10-year yield really to toggle between, I'm gonna use broad numbers, 4 to 5%, or closer to four and a quarter, 4.75, in that range. That's kind of our expectation, and that's based on many variables in and around inflation expectations as it relates to tariffs, as it relates to anti-immigration.
hmm
Conversely, how strong is the economy going to be if you unleash the animal spirits? The more M&A activity, the consumer's still out there spending. Think of it this way too, David. If we're right on our 6666 call in the S&P 500, you're going to add trillions more onto the net worth of households, these higher income households. That's just going to keep the economy humming and consumer spending humming as well. So I think that 10-year yield toggles between that 4 and a quarter, 4.75. I don't think it needs to break above 5% because of the inflation outlook, and I don't think it needs to go below 4% on any risk of deflation.
Well, did you find it a little bit odd, Joe, that it's been rising ever since the Fed first started cutting rates in September?
Yeah, I think everyone did, David. I mean,
Yeah.
it's still a head scratcher, and if you're trying to buy a home here, forget it. I mean, interest rates, a mortgage rate. So
Yeah.
yeah, but that's and a lot of folks, the economists out there, they said the Fed shouldn't have cut. They cut too much too soon. We'll see. The Fed wants to take out insurance policy. So where's the terminal rate? No one really knows. But it is odd. It's an anomaly that you have the Fed cutting rates into an economy that's growing by over 3%. And I think that's what the market's telling us in the sense that the economy doesn't, really warrant in general. And that's another one of our themes too, David, in the sense that the economy just doesn't, reply in the traditional sense that, well, if you raise interest rates,
Yeah.
the economy slows down. It didn't happen. Housing for sure, some manufacturing, but these tech companies, they have loads of money in it themselves. They have their own capital to fund the capex spending boom that's still out there. And then when we're coming out of the pandemic, U.S. households, the savings rate, the debt as a percent of the disposable income, they're in great shape too. I mean, households and corporations, debt-wise, are in great shape. It's the federal government that isn't. So
Mhm.
those two components are driving growth.
So that means the yield curve has been steepening. The 10-year minus 2 years now in positive territory. It has been ever since, I believe, the fall of this year. Yes, September. For the first time, really, since a couple of years ago, since 2022. How are you playing this steepening yield curve?
Yeah, we're still looking at shorter durations, right? And we're, 2 year, 5 year. That's kind of where we're putting money to work in the fixed income markets. Private credit is more attractive as well. We're
Hmm.
trying to get people out of the money market funds. I mean, as you know, there's 6 trillion plus, I think 6.7 trillion in money market funds. That's been a lot stickier than we expected. So we expected more money to flow into fixed income. That hasn't happened yet, but a steeper yield curve would suggest that investors should start thinking about getting that fixed income from more of bills, notes, and alike. So I think that's going to be a big variable in 2025 is how much of that money comes out of money market funds into other asset classes.
Great. Well, let's finish off on asset allocation then. Given everything we've discussed so far, Joe, what are your preferred, I guess, asset classes or sectors for 2025?
I mean, David, we still prefer the United States over the rest of the world,
Hmm.
basically neutral on developed and the emerging markets. We want to be opportunistic. We hear the story that it's cheaper overseas. We get it, but we just think the U.S. continues to power ahead in terms of growth, in terms of earnings, and particularly earnings sentiment and momentum.
Yes.
And here at home, we like the industrials, we like value over growth, but we own both, right? It's not either or. You want to own both. So anything on a pullback in technology, if you don't have the exposure where we're going for, we like the financials. We're neutral on the. We think healthcare is interesting. We're still like utilities because of the data center play. So really across the board, there's I think the big story this year, 2025, it could be the REITs come roaring back. We'll see. We like to pick around the unloved parts of the market, obviously at year end, to see how we shape up going into 2025. So it's really a barbell strategy. We like growth and value. Our bias is probably more towards large cap, but we also see the mid cap space being attractive. So there's a lot out there to kind of consider. And we do expect, and we've been wrong here thus far because it turned, better breadth, right? Not the, 5, 6, 7 companies to pull us ahead in 2025, but better breadth overall.
How do you feel about stocks over bonds over cash for 2025?
More stocks than bonds as opposed to cash, right? Because we
Okay.
got a good economy. We got a Fed that's going to basically go two and done. That's our call. Earnings outlook looks good. Maybe there's a little bit too much optimism in the street in general,
Yeah.
which worries me. But I think it'll be backed up by an economy that's going to surprise to the upside. The biggest thing, David, next year is going to be, Washington moves a lot slower than Wall Street wants. So Wall Street's patience is going to be tested by a Washington machinery that just grinds very, very slowly. And I don't care if it's the president doling out tariffs on day one. These policies take time to be put in place. So Wall Street's patience are going to be tested by this immovable object called Washington.
Could it be possible that we could be disappointed by some of the lack of policy changes in Q1? Like you said, they take some time. A lot of the expectations have been priced in already, Joe.
That wouldn't surprise me at all, David. But I think that would be healthy, sets up for,
Hmm.
We kind of reset at a lower part of the, kind of what we talked about earlier, 6,666 on the S&P.
Yeah.
Where it's not going to be linear. And that's exactly right, because we're not, our first 100 days, I know President-elect Trump wants to bust out a gate, get this things done. Washington just doesn't work that fast. But
Yeah.
that pullback, that impatience is a buying opportunity because we do think there's more deregulation coming. There are some good things coming out of the corporate individual tax rates. So be patient, buy the dips, buy high quality, be U.S. focused.
Final question, Joe. DXY, you mentioned you're overweight U.S. versus other markets. Are you expecting the dollar to remain strong then? Is that your assumption?
I think the bias, yeah, I think the dollar stays stronger for lots of reasons, David, in the sense that the Fed's not going to be cutting as much as other central banks. U.S. continues to grow faster than the rest of the world. Europe's got to get its act together. That's a whole other show
Hmm.
to talk about. It's still muddling along, not much competitiveness there. Maybe a bottoming out here. And then China is kind of a known unknown, but their currency isn't convertible. So yeah, the dollar to us remains, we just hope the dollar doesn't become too strong, overly strong for all the reasons we just talked about.
Yeah, okay. Makes sense. Thank you very much, Joe. Appreciate your time. Where can we learn more about you, read your work?
You can go to Merrill Lynch, Merrill, or Bank of America. You can see our material out there, and if you have any questions, get a hold of me. We can take care of that.
I've done some research on you. You have a tradition of recommending top recommendations for readings every year for the Economic Forecast Summit. Do you want to share a few books that you're that you think we should read in 2025 before we go?
Yeah, I mean, one couple. I mean, one in particular it's called The Launchpad Republic: America's Entrepreneurial Edge and Why It Matters. Launchpad Republic. It's a great book, and it just speaks to our DNA, the U.S. economy, our entrepreneurship, risk taking. The ability to fail, get back on our feet, and do it again. And so it just speaks volumes about our DNA to relevant to the rest of the world. And then another one, I mean, the book has been out there, but Elon Musk by Walter Isaacson.
Mm-hmm.
I mean, it's a fascinating profile on a person who's very important to President-elect Trump and the world. So I highly recommend that book because it gives you an idea, behind the scenes idea about how he thinks, how he works. He's a fascinating personality that's, probably one of the most important people in the world right now.
All right.
The book.
That was Joe Quinlan. He is head of market strategy at Bank of America. We'll speak again soon. Happy New Year to you, Joe. We'll speak in 2025. Take care.